Hi, this is Don Gooding with the 4 Colors of Money for Entrepreneurs. This video is called Coming to Terms, Understanding Term Sheets. The goal is to help give you a basic understanding first of what a term sheet is, and second, what those terms are all about, specifically terms for preferred share equity. So if you've seen the video on the 12 steps of equity fundraising, you may remember that term sheet negotiation is step 8, typically after most of the due diligence has been completed. Some companies like to have a proposed term sheet even before step 4, but that isn't necessary. However, it is definitely well advised to start learning about term sheets well in advance of when you actually are at step 8, because for most entrepreneurs, this is a foreign language. And let me give you one quick pro tip. Buy the book Venture Deals by Brad Feld. I know this is going to be just about the last time I'm going to plug the book, but it really is the best resource out there to learn the subtleties of term sheet negotiation. But if you're not quite ready to shell out the $30 for the book, or you prefer to see a video summary, watch on. So what exactly is a term sheet? From a legal perspective, it is an agreement that leads to a contract. So it's the first step towards an investor and a company agreeing on lots of details. In a term sheet, both parties, the company and the investors, are given specific rights, which must follow applicable laws. That second point is important because no terms in a term sheet can violate either the laws or regulations of the appropriate jurisdiction. Term sheets are used in most early stage investment, except perhaps for when a wealthy individual sits down over dinner with an entrepreneur and writes out some specifics about an investment on the back of a napkin. Although if you think about it, that's kind of a term sheet as well. The idea behind a term sheet is to outline the major points, the business points of the agreement between the investors and the company ahead of spending lots of legal time on the very, very detailed final documents. And then those final documents are a binding contract and are based on the term sheet. Term sheets have been used for decades by venture capitalists, and angel investors, particularly angel groups, have been using them as well. And as with other parts of the startup ecosystem, the US has been highly influential on what goes on in this part of being a startup. So, to see an example of a term sheet wherever you are, I highly recommend downloading the model documents from the National Venture Capital Association as well as the Angel Capital Association. I should note that an experienced securities attorney will likely be familiar with these model documents, but also have their own model documents for term sheets that take into account local investment dynamics. So it turns out that these model documents from the NVCA and the Angel Capital Association will be helpful for you to learn what a term sheet might be like, but it's actually going to be cheaper to use that template from your local securities attorney. Surprising, but true. And if your attorney doesn't have their own adaptation of these kind of documents, think hard about whether or not they have enough experience to help you through this process. What are the terms on a term sheet? There are a lot of them, so I'm going to separate the equity deal terms into 4 different buckets. First, deal economics. Second, exit or liquidity related terms. Third, investor protection. And then fourth, management and control terms. I'll elaborate a bit in just a minute, but there will be separate videos for each of these four buckets with a lot more detail. And then there are also some term sheet agreement related terms. In particular, you should expect a no shop or exclusivity term that says basically you can't use this offer to go shop for a better offer with other investors. That goes along with a confidentiality term as well as an expiration time. So you need to be ready to negotiate the term sheet before the offer comes in. Let's dive just a little bit deeper. Deal economics terms include, first, the pre-money valuation of the company. Second, the option pool set aside for future employees. Also, the liquidation preference, which is how much and when investors get paid if the company is sold. And finally, dividends. Exit and liquidity related terms include drag-along rights, which means small shareholders can get dragged into an exit. Registration rights, which basically means investors say, don't leave me behind in an initial public offering. And then redemption rights, investors saying, I need to get my money out someday. Then there are investor protection terms, starting with anti-dilution, which is a price adjustment investors get if in the future there's a down round, a round of investment where the price is lower. There are preemptive rights, which is the right to keep on investing in the company. This is something you want to see. And then finally, a right of first refusal or a co-sale agreement, which basically says nobody gets to sell their shares without me having the right to sell mine. And finally, there are management and control terms. First, who gets to be on the board of directors and who gets to observe the board. Information rights, who gets to know how much and when. There are founder-related terms such as your shares vesting as well as non-competes. And then finally, what decisions require board and or shareholder approval. I'd like to finish this overview of term sheets with a few general insights. Financing is a marathon, not a sprint. So the terms that you negotiate now are going to need to be acceptable not only to you and your investors today, but also to future investors. So what does that mean? Don't include wildly out-of-market terms. For example, a wildly high valuation for your Series A. Down rounds in the future are not fun. Or even worse, today, a high valuation could be accompanied with another wildly out-of-market term like a full ratchet anti-dilution term. It's a subject for a future video, but suffice it to say it's not worth the bragging rights over a high valuation today. Other things to avoid. Building a huge board with fancy names that aren't going to add any value to your company. 9 or more people is crazy. 5 is a great board to start off with. And don't be giving special rights to specific investors, no matter how wonderful those investors might be. Those kind of special rights will come back to haunt you in future financings. This is the kind of advice that an experienced attorney will be giving you, so make sure you have an experienced attorney, and one especially that has a good reputation with investors. Tough but fair, easy to work with, not focused on the little stuff, looking at the big picture. That's what you want. And so, having read Venture Deals a couple times, that's my final plug, I promise, you'll be able to help manage your attorney to make sure that you're not negotiating and spending lots of money on unimportant terms, but instead looking at the long term and making sure that this first term sheet that you and your investors are negotiating will lead in the future to even bigger and better financings.